Functioning. I think we're functioning. Technology today. All right, there we go. Welcome back, everyone, to another Meet Kevin report. A lot to cover today. Obviously, this morning we started with a little bit of enthusiasm in markets. Quite a bit. In fact, you saw this serious enthusiasm on Tesla, which we're going to be talking about. We'll also talk a little bit about Robinhood, look at some financials as well. As cover tariffs, obviously, and recession thesis, Nvidia, and otherwise. So a lot to hit on here, and I think it's going to be fun. So let's get started. All right. So first, we're going to start with Nvidia. All right. The question right now is Nvidia orchestrating a Ponzi scheme with CoreWeave? Now, this is a really hard opening for a stock and company that I actually love. I'm a big fan of Jensen Huang. I think Nvidia is actually selling for a pretty reasonable valuation right now, about a 1.3 peg, which is pretty low given that they don't manufacture their own chips. They just design them. This is how they get to these 75% gross margins, which are amazing margins, mind you. They bring like 40+% to the bottom line. This is a cash generating machine. It's a fantastic, very rich, well-positioned, moated company with CUDA. But what's fascinating is there's some thought that maybe Nvidia is purposefully propping up CoreWeave, which we've made videos about, I'll give you a little recap, to make sure that the value of Nvidia chips doesn't fall. Now, just a few days ago, in my CoreWeave video, I showed you the clip where Jensen Huang tells us that the Hopper infrastructure, H100 chips, might be difficult to give away after Blackwell comes out, which is a nice argument that Blackwell's going to be really strong and good. But it's a really bad sign for anybody wanting to invest billions to hundreds of billions of dollars into server infrastructure. This is a potential very large red flag that the market for artificial intelligence is substantially slowing down, at least data center capex. For example, we heard the the chairman of Alibaba, we've already covered this, but to reiterate, the chairperson of Alibaba telling us, hey, we might be seeing a bubble in AI infrastructure. Combine that with the TD Cowen article, where what do we hear? Oh, Microsoft is scaling back some of their investments in data centers. Now, that wasn't exactly how they led their article. TD Cowen's analysis actually led by talking about Meta and Google stepping in place of Microsoft. And Microsoft is still bullish LLMs. They want to create their own LLM software to compete with OpenAI, even though they're investors in OpenAI. But TD Cowen was bullish in that they actually see this idea of a data center pullbacks over at Microsoft as maybe just a shift in priorities for Microsoft. Now, most people didn't talk about that, but the article, while it did reiterate that, yes, Microsoft has, walked away from 2 gigawatts of capacity in both the US and Europe in the last 6 months that were in process to be leased, it has also deferred and canceled existing data centers in both the US and in Europe last month. So in other words, this is why we got the news that there were actually more cancellations than we had first heard, because we first heard about this, a couple months ago, and now we're getting this news again. So it's not just what's been happening in the last 6 months, it's also what's happening in the last month. And it's sort of getting worse. Now, their view is that the pullback in new capacity leasing by Microsoft was largely driven by the decision not to support incremental OpenAI training workloads. However, now I'm going to throw in a note here. At the same time, if Microsoft doesn't want to support incremental OpenAI workloads because they modified their multi-year contract with OpenAI and said, hey, go ahead and use other companies like, let's say, a CoreWeave, and which we'll talk about that at Nvidia again in just a moment. This is very important to it, although somewhat tangential. OpenAI can now use other companies other than Microsoft. This thesis would make sense from TD Cowen, but Microsoft has now announced that they want their own LLMs rather than just rely on OpenAI, which is interesting because why are they canceling leases on data centers, old and new, and walking away from deals if they're also wanting to build out their own LLMs? Well, it's likely because, hey, they want the delicious data that comes from having your own LLM, but they don't necessarily need additional capacity because capacity is becoming cheap. And that's the problem of the potential quote unquote Nvidia Ponzi. I know it's a hard line. I'll explain why I'm saying that in just a moment. So to me, I don't think we can say AI demand up and people use GPT or Grok or whatever, therefore AI stock up. I think the days of that are over. I think we can all agree that we like using the GPTs or the Groks or whatever for encyclopedic purposes, for brainstorming, for ideation, for legal review, contract review, or just doing stuff we don't want to do. This is fantastic. But does it necessarily mean we need even more data centers than we've already built out? And the answer here seems to be mostly and resoundingly no, that we may have already hit some form of capacity. That said, TD Cohen actually thinks this is an opportunity for Google to step in or Meta to fill in and backfill sort of some of that canceled capacity. But again, the point of that is, hey, wait a second. If the other companies are filling in, then you're still building. Just like the chairperson of Alibaba says, hey, it's still getting built out even though we don't need it. Somebody's picking it up. Somebody's spending the money on it. It's probably not the greatest ROI. So my argument is while Google and Meta might pick up some of these leases, I think Microsoft is sending you a signal that the money isn't in the data centers. The money is in collecting data from people. By the way, who knows, maybe Microsoft will buy 23andMe and get all your genetic data. Which, by the way, in 2021, I got interviewed by NASDAQ about 23andMe. And I told them it was an overvalued stock and you shouldn't buy it. You can actually look that story up if you Google I'll just do it right now. NASDAQ, meet Kevin Paffrath, SPAC 23andMe. I'm like, no, this thing doesn't make money. There it is. First line, it is right there. VG Acquisition Corp SPAC deal with 23andMe is 2. And then it goes into like speculative is I think what the full title is. You can go check it out yourself. But they did that interview with me. Analyzing the SPAC deal with Meet Kevin. But anyway, what's really interesting is we have plenty of signals at the moment that the data center build out is probably overhyped. But now we have something else interesting that's happening. We have Nvidia saying they are going to buy up to $250 million of CoreWeave stock at IPO. Now this is really interesting because what that does is it creates a floor. Just this morning we heard that CoreWeave is actually downsizing their IPO from about $2.7 billion of expected proceeds down to $1.5 billion. And in addition to that, the price is going to be lower than expected. Nvidia now, by the way, coming in to backstop this at an anchor of $40 per share. Now, I find this interesting because Nvidia makes a lot of money selling to companies like CoreWeave. And this isn't solely about CoreWeave. It's about the entire industry. Think about this, okay? Let's just take this to the extreme for a moment. I always think when you do an analysis, you should assume the middle, but study the extreme, right? So in an example, you lose your job and we go into a recession and you can't make your payments. What is the extreme solution you're gonna have? When you analyze that before things go poopy, you know how to prepare yourself, right? Okay, that doesn't mean that's gonna happen. So if CoreWeave IPOs at $40 and Nvidia doesn't back them, and CoreWeave drops to, I don't know, 0, okay? Let's just go extreme. Go to 0. CoreWeave goes to 0. Well, what happens? Well, now all of a sudden the value of every data center in the country plummets, gets written down because of a failed CoreWeave IPO. The industry cannot allow CoreWeave to fail, which in a weird way is actually bullish for CoreWeave's IPO because you've got all these institutions that have so much risk of Nvidia stock going down. Think about any VC who's investing in these private data centers, or even honestly XAI in their Tennessee data center. If CoreWeave went to 0, the Tennessee data center that XAI owns would be worth substantially less. New data center projects would come into question. And then guess what happens? If somebody's like, hey, Nvidia, I want to buy 100,000 Blackwell chips to, invest in a data center. Oh crap, but wait, the last company that did that with Hopper chips, you guys bankrupted them by coming out with too good of chips too rapidly. Well, why the hell would I buy Nvidia chips and go into making a data center? You're basically buying at peak bubble for data centers. So it is industry critical that the CoreWeave IPO goes well. Even if you don't care about the CoreWeave IPO, if CoreWeave plummets, it's bad news for Nvidia, AMD, and any of the relateds. Super microcomputer for the infrastructure, Vertiv for water cooling. I don't really care what it is. Dell for the 4% of their business that's exposed to AI data center servers anyway. It's bad. So this is where the Ponzi thesis comes from. Let's take other money and funnel it into CoreWeave to prop CoreWeave up to make it seem successful, and then, pay out shareholders if the share price goes down to make sure the whole system still seems sound. Meanwhile, it's propped up by Fugazi just to prevent the entire thing from falling more substantially. Now, I'm not here saying CoreWeave's going to go to zero, okay? I'm just saying, even CoreWeave going down 20%, and let's say it IPOs, so usually what they do is they'll IPO at 40 bucks, but they'll probably be up at like $60 when it first trades because they purposefully restrict the shares. And we know Nvidia is putting a $250 million floor in at 40, so people will speculate this up to $60 or $80 or whatever. This is why you almost always see an IPO. It's like, it's up 50% on the first day of trading. That's all part of the marketing because the businesses want the article. That's like, look at how successful our IPO was. Even though they'll raise less money because they're not going to benefit from that run, it's the people buying it who will benefit from that run. CoreWeave will raise less money. It'll still be good enough because remember, they've got about it's like $2.8 to $3 billion of bills coming due this year. They don't have the money. $1.5 billion is going to help them. And then they can always issue more shares in 6 months. Although in 6 months, that's when your insiders are going to have a lockup expiration. So you probably are going to be more like 3 months before they start to raise money. And the issue with that is how much is that stock potentially going to fall and what kind of downstream effects is that going to have to other stocks? So I'm not saying, because I think there's going to be a lot of support for trying to keep CoreWeave propped up because it's so industry critical. So I'm not saying the stock is definitely going to go down. I'm not saying you should, short at day one because you could get totally hosed by, what I think is at play here. But my point is, what I would encourage is watch the financials of CoreWeave and the price action, because the price action of CoreWeave and the financials of CoreWeave will give you a really good barometer as to the future of investing in chip plays like Nvidia. So if I'm, let's say, a future Nvidia buyer, what am I looking for? Well, I'm looking at, hey, if CoreWeave plummets, maybe I'm less interested in Nvidia at today's price and I'll wait for it to be $80 or $60 or whatever. If CoreWeave takes off, it stays up, they do their secondary offering, it keeps cranking 6 months from now, they have their insider transactions that unlock, and after those unlock, they're still doing well, and they're able to raise money and invest more into data centers. Great. That's supportive of Nvidia's stock. So think about this as sort of a canary, if you will. The canary has arrived to the proverbial coal mine. What's next? That's really anyone's guess. So we'll see what happens there. But that's my thesis on CoreWeave. Okay, good. So that gives us some thoughts on CoreWeave and a little bit on chips. Now what I'd like to do is I want to go through this soft landing article. And T.S. Lombard actually, I think, did a fantastic job on this piece. I've always liked reading their stuff. I think they've been a little blind under the Trump-hopium of the last 3 months to some of the risks that our economy was about to face. And I think now they're waking up to some of those risks. And I want you to see kind of their transition. In addition to that, I think it's also worth just taking a quick glance at what's going on in the markets. Look at that Tesla move. Break out of my 274 line only to come right back to it. Holy smokes. And even McDonald's is red today. Now that's something else. All right. So All right, let's get into the economy. All right, here we go. It's so freaking hot in here. Open this up a little bit. So, both the ACs, I got 3 ACs in here, only one of them's working. And the HVAC company is like, we have to do many hours and days of diagnostics. And I'm like, y'all suck. All right, so, man, it really is hot. Hold on, let me see here. I'm gonna go. Oh, perfect. They were able to move me up to tomorrow. Thank God. All right, here we go. So, this morning we did some recessionary analysis, and TS Lombard, who's been a bull, is still a bull on soft landing, but they're seeing some cracks, and they give you an outline of what to pay attention to. It is worth noting that so far, I've been studying the earnings calls of a lot of different companies, and while the International Monetary Fund doesn't see a recession on the horizon, although they do suggest slower growth, and even companies like Paychex don't see indicators of a recession at the moment, it's worth noting that a lot of these businesses refuse to tell you in advance if they think a recession is coming, because usually if one company is like, yeah, we think a recession is coming, people think that company just sucks, and then they sell the stock. If people don't think a recession is coming, and they're like, oh, there's no recession coming, people might be more likely to buy those publicly listed stocks. So I think there's some, reading in between the lines you have to do with a lot of these companies, and you're finding the general theme now is slowing and uncertainty. Now we're going to see some things to look for from TS Lombard regarding the brittleness of the economy. But it's also worth noting this morning, Bloomberg Intelligence suggested that Q4 was peak for global earnings growth, as now tariffs have increased volatility, sky-high AI earnings growth is slowing, and higher rates start to bite. Now, obviously, we could get a lot of enthusiasm that rapidly comes into the economy if Donald Trump ends up striking tariff deals, which we'll separately talk about some tariff deals that I think could be on the horizon. But first, let's talk about TS Lombard and some of their data, which is quite interesting, as well as considering that while JP Morgan is seeing some deceleration in spending growth from consumers, they, on their card platforms, are still seeing growth of around 2.6%, with Gen Z and millennials really driving most of that growth, Gen X and boomers really accounting for almost flat growth to slight growth. JP Morgan, it's worth remembering, is a much harder credit card to get access to, or any of their cards are a lot harder to get. They're not going to really appeal to lower credit scores, lower income individuals. They're a little bit more of like a bougie bank, if you will. So it's worth noting they're not the I think, best cross-section of America. They're a little bit more of the bougie cross-section of America. That's my take. And yeah, we bank with JPM, sorry. But anyway, let's go into, just worth knowing that, because I remember being 18 and applying for credit, and it's impossible to get credit from JPM. And it took years to get in. You'd have to go to, Wells first, or Citi, Discover, those are usually your founders. So everybody goes through it. But that's a note from JP Morgan. And now let's take a peek at this TS Lombard piece on the brittleness of the economy, because they're going to give us some more insights into this slowing as well, in their opinion on this slowing. So let's take a peek of this. So Trump 2.0 is proving a lot less reflationary than the consensus assumed, with the threat of tariffs and Doge spending cuts undermining confidence. We think the U.S. economy can withstand these shocks. A soft patch is likelier than recession, but budget consolidation is risky without a monetary offset, so it'll be important to monitor the labor market. So we need to explain this. And there's a lot of detail in this, so we're going to go through this and see this here specifically. So what do we have here? While we would not describe the latest U.S. data as recessionary, they see a growing sense of anxiety about where things are going, and they think the most important place to watch is the labor market. I just want to remind everybody, the problem with the labor market is it's very, very slow to give you any kind of leading indicator. In fact, it's more likely to provide you lagging indicators than any kind of leading indicators, which is quite unideal. I'm trying to find where this comment is. That's okay. We'll find that later. So we'll go through this line by line here. Oh, it's a stupid Apple. That's why I'm zooming in my pages like this. Okay, there we go. Today, the sense of optimism that we got from Trump has disappeared. And there's this question about, hey, are we just unwinding the animal spirits of what Trump brought us with the election? Or are we going to see more of this, where this is more than just a reversal, and is there potentially more damage coming to the economy? And their point of view is nobody expected Donald Trump to inflict pain on the economy. In fact, they go as far as saying that they thought, as well as a lot of people, that Donald Trump would be arbitrated by the stock market. Now think about that phrase for a moment. It's a really interesting phrase. An arbiter is a form of a judge, right? But it could also be somebody who sort of dictates proceedings and how things are to go, right? So imagine this arbiter over Donald Trump. No, Trump. Don't. Here, hold on. We need a prop. No, Trump. Don't do that. The S&P 500 is going to go down. Okay, that's what people thought was going to happen. The reality of what we've been getting is, hey, Trump, did you see the stock market is down 2%? Huh? What? Today or in general? No, it's down 2% today. It'll sort itself out. That is not the Trump. That, by the way, is exactly what happened yesterday. That's not the Trump markets expected. And T.S. Lombard is basically saying this is an adjustment for markets. We don't have somebody who's bound by what the stock market is doing. And this idea that we have essentially a government that's willing to inflict pain or detoxify the economy is a risk. And so they provide 3 recession risks, even though they are not forecasting a recession. They say, first, we don't have a monetary offset. This basically means we don't have JPOW printing. Okay? Easy enough. Number 2, they think the combo of Doge and tariffs is dangerous because Doge creates negative fiscal spending to the extent that it's successful, and tariffs encourage the Fed to hold because of the inflationary risks. In addition to that, while the broader private sector is really healthy, including larger businesses that are doing very, very well, small to medium businesses have really big risks, and the risk is increasing. It's worth remembering that about half of employment in America is small business employment. That's a really big deal. So now they argue that 3 months after the election, it's really hard for investors to start dismissing the bad, especially since tariffs, deportations, and Doge are happening now, whereas tax cuts and deregulation won't happen until 2026 or beyond. How funny. If only there would have been a YouTuber that told us, be careful, the good that Trump is bringing you isn't going to hit until 2026 or later, and the bad is going to hit up front. And you should be really careful of Q1. Oh, that's what we did. It's okay. Sometimes you got to pat yourself on the back a little bit, but we don't want to get cocky here. Nobody's perfect, and we don't want to crash. I know some people do because they think it's gonna be good. Let me put it this way: no economic recession is good. Everything sucks. It doesn't matter. So anyway, okay. So what else do they say here? Optimism giving way to genuine investor alarm. If so, why? So basically, they're arguing here that authorities within the Trump administration, when it comes to tariffs, are basically going beyond this, hey, we're going to use them as a negotiation tool tariffs. There's actually this, they call it an ideological belief that the Trump administration is going to go all in on rebalancing global trade, and that the ideology is the world must pay for America's taxes, and that this is not just a short-term pain or detox because, after the Biden admin, but rather this is some long-term transition that's just not going to happen overnight. T.S. Lombard sees that as a longer-term risk because they say here short-term pain is a real possibility and the promised long-term gains are speculative and based on specific political ideology. Now, this is really interesting because it's a way of essentially saying, hey, like, you know, if you're MAGA and you're all in on Trump, like, it'll be fine, great, but it usually isn't. Because when things in the short term start compounding in a bad way for longer, you end up, quote, feeding on themselves, like these issues feed on themselves and can even leave long-term financial scars. They write this. Does anyone seriously believe, for example, that an economic downturn would lead to an improvement in public finances? Spoiler alert, no. They're going to print money and we'll be in more debt than we ever have been in before until the entire financial, monetary system collapses and the economic Ponzi is over. Now, I don't think that is imminent. I think it'll be in a few hundred years. It'll happen eventually, but I don't think that is imminent. That's just my opinion, though. But I also don't like holding cash. You know what I really prefer over cash, and we're going to keep going with this recessionary article here, although they're more of a soft landing argument, is house hack. That's because I think diversifying to real estate is exactly what you want to do right now, and here's a 45-second pitch on house hack. Go, roll the ad. Hey everyone, me Kevin here, CEO of Househack. If you want to diversify into real estate, go to househack.com. We buy the real estate, we manage the real estate, we deal with all the tenants and toilets for you. And look, we have a beautiful website. You want to invest? You can now even invest as an accredited or non-accredited investor. You get 100% of the upside. You get paid a 5% yield with all the upside of the company's stock, and we do all the work for you. If you want to see or learn more about our investment offering, our offering circular or PPM if you're an accredited investor, or what it is that we do, or pictures of the properties that we own, some of our finances or whatever, make sure you go to househack.com. Now open to accredited and non-accredited investors. All right, ads over. How was that? I think it was good. Now, let's go to this piece again. Cool. The reality is that once a recession starts, nobody knows just how bad the situation is going to be or how long the downturn will last. And once U.S. unemployment starts to rise, it usually rises a lot further. There is no doubt recent U.S. economic data has been soft, particularly compared with bullish expectations. The macro surprise index plunged at the start of the year, retail spending has been subdued, and confidence has clearly deteriorated. It seems that uncertainty is encouraging businesses to postpone hiring and investment decisions, while talk of economic pain is never good for consumer sentiment. You know, I heard this is just an anecdote, but I heard somebody was applying for a job, and I was hoping they'd get it at a certain Mag 7 company. And apparently, for that job, there were 1,500 job applicants for the same damn job. I'm like, oh no, this is a fundamentally bad thing, especially when people that I actually think are quite smart, high IQ, high effort, high energy individuals who deserve the job can't get it because of macro. That's what pisses me off, because now, that's why I say you shouldn't cheer for a recession, because you can be the smartest person in the world, you can have the best skills or talents in the world, but the data just gives you a middle finger, and then it's like, bro, this is some bull. Now, that said, so far, we've been doing okay. I mean, if you look over here, as they say, the labor market has been stabilizing back to 2019 levels. When we thought payrolls were slowing down over here, we bounced both times. We've had a slowdown. So maybe this is all part of just, an adjustment phase or the normalization phase. I don't think so. But that's what a lot of people think, and that's okay. Maybe that it will be like that. I hope so. That would be Goldilocks, right? Here's your challenger job cut layoffs chart, and here's their thesis on Doge. So their thesis is Doge will fail. Now, they make the argument that Doge will probably not cut anywhere near as much as they're capable of cutting because their wall of receipts has been mostly fugazi. But let's say they're even remotely successful. Losing 300,000 workers at the federal government would equate to an extra 20 basis points of the unemployment rate, which in a healthy economy, the private sector should be able to absorb. But the job losses will be larger if we take into account the shadow government employees, contractors, or those who depend on government contracts and subsidies. Since there are 2 shadow workers for every federal employee, that could bring the total job losses to over 800,000, or an extra 50 basis points of unemployment. And that's where things start to get interesting because why, as they say? Well, it triggers the SOM rule again. You remember that like false indicator that we got in August and then we revised away the SOM rule? Well, usually when we actually break the SOM rule and we're not just revising it away, thanks Biden, we add 50 basis points to the unemployment rate over the last 12 months, low, 3-month moving average low. Then what happens? Well, once that joblessness increases that much, it usually keeps rising by likely another 1.5 percentage points or more. We also know that the jobs market is currently in a fragile equilibrium. I agree with that. Both layoffs and hiring at very low levels, which means that former federal employees might find it hard to secure new roles, and it won't take much of an increase in layoffs to unsettle the current equilibrium. This is the thing. This is why Jerome Powell, people listen to J Powell and they're like, oh, he sounded dovish. And I'm like, did you pay attention? He literally told you to your face that layoffs are the last line of defense. We are literally at war with the economy. And the last line we have in our tower defense of the economy is a low layoff rate. The second that low layoff rate breaks, it's like a levee. And that unemployment rate skyrockets fast because then it becomes normal for businesses to announce layoffs. Roughly half, it's like 45% of our labor market is built by small businesses. Small businesses are getting hosed right now. Small to medium are screwed. It sucks. Does Apple give a flying hoot or Berkshire Hathaway? No, they have more money than God that they're sitting on. Fine. It's because God doesn't believe in paper currency. In fact, he told me that he believes in HouseHack and investing in diversifying to HouseHack. HouseHack.com, sponsored by God. All right, where were we? So here we have a government decision to trim the size of the workforce. So what they're saying is normal recessions have their root in some form of fundamental or like underlying macro financial imbalance. And then that's where things become unstable. And then there's a painful adjustment phase that gets triggered. Here, this adjustment, they say, is sort of more like self-imposed. It's basically a, Trump move that hopefully does not turn into a spiral. Because if this is enough of a tipping point to trigger a broader private sector retracement or retrenchment with jobs, you have to be careful, basically. So, in other words, let me rephrase this. If job losses are bad, and the private sector picks up those jobs, or even city or local governments do, or state governments do, not that bad, no spiral. But if the government layoffs spill over into private layoffs, especially in that small and medium sector, you're screwed. This is bad. Now, obviously, tariffs are already impacting and slowing down spending. Best case scenario is companies just pay the tariffs and we move on. What else do we have here? I really hate that this is not a progressive scroll. There we go. Oh, thank goodness. Oh, that's so much better, Apple. Who would ever scroll by page? If you're a page scroller, leave a comment so I can make fun of you. We need continuous scroll. Anyway. All right, so where were we? All right, here we go. Consumer confidence, minus fewer job opportunities. If this breaks lower, it could signal recession. Okay, not a good chart. Got it. It would be a stretch to say the economy is already turning to recession or that such a downturn is inevitable. Right. So in other words, it's not a foregone conclusion that we're definitely screwed. It's just starting to smell like we're screwed. I kind of agree with that. Like, if I thought we were definitely screwed, I'd be a 1 on the bear bull scale. I'm like a 2.9. I have some hope left. I'm like, maybe Trump will make a deal with the Canadian Prime Minister or, Claudia Sheinbaum of Mexico, whatever. We'll talk about that soon. But anyway, let's take a look here. Again, with this back-of-the-envelope calculation, we're not taking a recession-sized hit to the economy with potential Doge-related layoffs. Muck around and find out. Okay, that's like a reference to Musk. Hidden vulnerabilities. U.S. households and corporate financials show a surplus, and it's rare to see this, going into a recession where everybody's got good cash flows. But the trickier question is, are we hiding vulnerabilities? And the vulnerabilities to pay attention to the most are here. Outside of superstar companies, which may be flattering the aggregate data, many small to medium enterprises are struggling. If Trump's policies prevent the Fed from cutting interest rates, those companies will face an additional monetary squeeze over the next 12 months, with debt servicing ratios set to rise. Poopy doopy. So, what's the bottom line? Well, T.S. Lombard says a soft patch seems much likelier than a recession. Well, just keep in mind, and this is me adding my own little salt. Salty, Kevin. They were really bullish a couple months ago. Sorry, I actually do respect the T.S. Lombard folks. And I think this is, this isn't like a mea culpa, but this is a reasonable response to the data. So, Dario Perkins, you perked me up with this one. I think you're aligning. I think this is a very fair take, and I think it is entirely fair to be more bullish on soft landing. Maybe if he had a bear bull scale, he'd be at like 6.9, okay, 69, and I'll be at 2.9, all right? Fine. Everybody can have their own opinion, right? This is not like an on or off light switch where it's yes recession 100%, no recession 100%. It's degrees of certainty, and we'll see how things evolve. But my concern is that their monitor, what they want to pay attention to, the labor market, is just going to lag. And by the time the unemployment rate goes poopy doopy, which could happen within the next 6 months, it's too late. Stock market's already going to be mega freaking pissed. So we'll see. I actually think that's one of the reasons we keep seeing these fades in the stock market, mind you, because I think people are realizing that there is actual weakness coming. That this isn't like some clickbait over, oh my gosh, it's definitely going into recession tomorrow. This is all about odds and being prepared and then keeping an eye open with perspective. So that way you in your life can look around and go, okay, how do I actually feel about my debt situation or my cash flow situation? Am I diversified enough for this? The whole point is just to give you a little bit of a heads up so you can kind of start thinking to yourself, all right, yeah, these are issues. And some of the, staunch bulls are turning a little bit more bearish. Now, my favorite time to invest is when all of them are mega bears. When all of the institutional analysts are like, this is the worst ever, it's never gonna get better. Great time to invest. Mostly, I think that's true because I remember back in 2022 when I launched, my fund. I'm like, dude, we're launching this at the bottom of the market. This is great. Everybody's so bearish. People are like, why are you getting into that? And it's funny because I purposely, in part, closed it in February because I'm like, I think we're about to fall off a cliff. So I handed people basically a giant egg of cash that had grown in value, 24, 25% or whatever it was since December of 2022, which is pretty good, for the 2.5 years or whatever it was up. That's including the hedging that we had to protect against the downturn. And sort of like, hey, I think things are about to fall off a cliff. Here's an egg of cash. Good luck. We grew it. I think that's quite interesting. In terms of macro timing, and it gives you a view of where my head is. But maybe I'm too negative. I hope I am. So maybe it'll turn out that being a 2.9 on the bear scale was just too bearish, and I should have been around a 5, or maybe I should have been with Dario at 6.9 or whatever he's at. Everybody should have a bull. We should all have T-shirts that are mandated. We walk around wearing those T-shirts, and they tell everyone what level bull bear you are. So when Peter Schiff walks in and his is at 0, because he's that bearish. Well, then we know the disposition, and then we can listen to why. Anyway, congratulations, by the way, house hack. Yesterday, the house hack investments exploded. I'm looking at it right now. I'm like, man, we didn't think we'd break those numbers this quickly. So pretty impressive. Again, I think this is what we're seeing is we're seeing a fading of risks in the stock market, and people are diversifying to other opportunities. Anyway, all right, good. That's that. Congratulations. So now what? Now what we're going to do is we talked about Nvidia, we talked about the market. Now we're gonna do Let's see here. Let's see here. All right. Let's go. How? Okay. Good. Okay. Next up. So what else do we have here? So, oops, that doesn't work. I'm trying to pull something up, but I cannot get it to pull up anymore. Nope. Okay, that's fine. All right, good. So we talked CoreWeave, we talked recession. Oh yeah, the tariff plan. Now this will be entertaining. Okay, good. Now ZA, you've lost your marbles. That ETF outperformed for 75% of its existence. It'd be outperforming right now as well. In fact, year to date, it's outperformed every single index that there is. You know, if you're referring to that little period of time, a little 2 or 3 month window where, you know, things went bananas in the stock market and we had hedges, well, then you're just frankly delusional. You know, to imply that at every little segment of an institution or fund's existence, it should always be outperforming is psychologically wrong, but it's also almost like borderline stupid. You can't expect that. And then you also have to weigh what protections to a downside were included. You know, what upside could you have gotten from downside protection? And you know, people never account for that. So, you know, portfolio creation is about risk management. It's not just about being in every single YOLO and then all of a sudden it loses 50% because, you know, people put all their money in at the top. So, you know, to argue that hedging in exchange for giving up some euphoric gains is somehow wrong is completely moronic. And you should go back to Finance 101 and understand what it means to protect from downside. In fact, this is exactly what we do at HouseHack as well, is we protect downside. Because I don't want to be some YouTuber who's here today, launches a Hawk coin, and then it's gone, and it's rug pulled. People lose all of their money, which is dumb. I'd rather say, hey, you know, we're going to try these opportunities. Cool, we make some money here. Great, here's your money back. Now we're going to do these opportunities. Let's do it in a safe and conservative way to build on strong fundamental foundations rather than on Fugazi, financial analysis doesn't matter, you know, Trump won, back of the hand, what stock's going up today, let's buy that math. That's retardation. So, you know, sorry for using the word, but like when people leave these comments, I think they're so disillusioned from reality that they really don't understand what the whole point of running a portfolio is. You do it. So I'd at least have the balls to try. So anyway, but that's okay. Most people don't have that those balls. They sit behind a little keyboard and leave stupid comments. But that's okay. Like I'm still going to be doing this in 50 years. And we're going to be proving the value over the time of my career. That's my goal. And then hopefully, you know, many more years after I can't anymore, you know, in 100 years. And other people are taking that legacy from our team. So now what we're going to do is we're going to talk about tariffs. Well, ZA, that's even more sad, isn't it? Okay, let's see here. Let's get to tariffs. Okay, so let's do this. Okay. Donald Trump not only just announced auto tariffs, but he also plans to double down on duties on Canadian softwood lumber, which is involved in toilet paper manufacturing, which does have the potential of meaning that if Canadian softwood lumber prices go up to 27%, maybe even up to 50% once retaliatory tariffs are accounted for, we could be in for more expensive housing development, construction, remodeling, and toilet paper. But I think what's more interesting right now is the impact of tariffs potentially on the autos industry, and specifically Tesla. See, we know that these auto tariffs are really bad for countries that, or companies rather, that went all in on the USMCA trade agreements like GM or Ford. There are current estimates circulating that GM could lose about $14 billion per year in profit thanks to tariffs, and Ford potentially around $6 billion in profits. That would wipe out nearly all of GM's profits and about 75% of Ford's profits. That's a problem. And that's because they've integrated so well in between Mexico and Canada that these really American companies are in for, well, the frying pan, at least in the short term until exemptions are carved out for USMCA style products. The question is, how do you actually determine that something qualifies under USMCA? Well, it's very difficult because you have to now sort through, well, we have a computer that has chips from Taiwan Semiconductors, and 10% of the computers from Taiwan, and 10% is from Singapore, and 10% is from South Korea, and that transmission is from Germany or whatever. You actually have to individually itemize, basically like throw into a recycler one of the vehicles and try to figure out, sort out, well, that's a European part, that's an Asian part, that's a North American part, but it's actually not just North American, it's Canadian or it's Mexican. That's hard, and that's going to take a very long time to get these logistics working. In the near term, I don't expect a rapid increase in pricing for new vehicles, mostly because we have an excess of supply for new vehicles. We've really overbuilt post-COVID because we've expanded those supply chains, and so generally you're not seeing a shortage of new vehicles. However, it is likely that new vehicle prices could rise to the tune of $3,000 to $6,000 very rapidly, once that existing supply sort of wears away. That's likely to sort of depress demand and, again, lower durable purchases in the future, not so much right now as people might want to rush to buy a car before those tariffs come out. In fact, if I were a car dealership, I'd be running a tariff sale right now and go and get in before the tariffs actually hit. Now, Donald Trump responds with an interesting POV, and we talked about this yesterday, this idea that the government, basically Congress, should pass some form of tax cut. And that this tax cut should be some kind of vehicle incentive. Now, what's interesting about that vehicle incentive is it's kind of like, if you think about it, the EV tax credit, right? Tesla already has the EV tax credit, but what'll happen is you actually end up moving from EV tax credit to, well, guess what? All vehicle American tax credit, which actually dilutes some of that competitive advantage that EV manufacturers like Tesla had. In addition to this, you have Elon Musk suggesting that it's important, his line, okay, this is not just a suggestion, it's literally his quote. He writes the following on X: "Important to note, Tesla is not unscathed here. The tariff impact on Tesla is still significant." Now, I actually think this will create some opportunities. And now keep in mind that initially, a lot of folks, like, it was my first reaction too when I heard about, tariffs on cars not made in America. My first reaction was, oh my gosh, this is amazing. We are going to, this is a great prop up for Tesla. It's an American assembled vehicle, basically in full, Fremont and Austin. But when we started finding out that the tariffs will be levied based on how much of the car is made from foreign components, well, that's when things become a little bit more problematic. About 60 to 75% of Teslas are made in America, but that other 40 to 25% component is going to be subject to taxation. About 80% of Ford vehicles are manufactured in America with American components, but again, you're still going to have a hit on the other component. Those are probably your two least affected auto manufacturers, Ford and Tesla. But others, GM and others are going to get hit a lot more. Obviously, foreign brands the most, like European autos, Sprinter vans, which a lot of them are assembled in North Carolina, but that's because we ship the parts over from Germany, and they're still using a lot of German parts, along with parts from around the whole world. So there are always ways companies and corporates try to rejigger how to get around tariffs. Sprinter vans are the perfect example because we ship them in parts to North Carolina and assemble them in America, so it's assembled in America. But if these tariffs are really going to be allocated based on the true percentage of parts and their true country of origin, then you're really going to have serious problems. So now, what I actually think could be a great opportunity for Tesla is building a factory in Mexico. Now, you might think, holy crap, Kevin, that's like the dumbest thing you could possibly say. Why would you want to build into Mexico? Well, Exhibit A. Mexico seeks preferential treatment from Trump on tariffs. So in other words, Claudia Sheinberg is going to do whatever they can to bend the knee to Trump to get some exemptions. This actually creates opportunities, because if Mexico gets exemptions, then Elon Musk can be the first American company to announce, we're building in Mexico again. Giga Mexico's back. We've got the plans, we got the permits, we got the location, and guess what? Tesla comes back as the first company that brings us to free trade under Trump's new partnership with Mexico, builds a factory with the excess billions of dollars of cash they have. They've got plenty, they've got over $20 billion of free cash, mind you. Free cash. That's, cash minus accounts payable. They've got plenty of money. Take 10 billion, build this amazing factory in Mexico, and now you can take advantage, and I know I'm using the word take advantage, but it is what it is. It's the fact. You take advantage of $3.50 per hour labor versus the $35 an hour labor you're paying for a union worker in America. And if you're not paying a union worker, then you're paying an ununionized employee probably similar wages anyway to be competitive with the union workers. Otherwise, you're not going to get auto workers. So the auto workers union, the UAW, does not want to see that, but I think this is going to happen. So I see it coming, and I actually see Tesla taking advantage of it. The way tariffs are right now, I do not think are good for Tesla, because the battery manufacturing mostly in China is going to hurt. And the batteries are where most of your margin is on these Teslas, especially with lithium prices plummeting. That's how Tesla has maintained a lot of its margins. If you can now manufacture in Mexico as part of a new free trade, announcement, that would be a game changer. Now, obviously, this is speculation. We don't know if that would happen. We do know that permits and plans are ready for Tesla to build in Mexico, but you've got a few problems. One, you're a little bit demand limited on Tesla right now. Let's be real. Okay, sales are going to be negative this year. So you don't necessarily need another factory. But if you could do another factory and now make the cars cheaper, or make your $25,000 Cybercab in Mexico, not too far from where Giga Austin is, well, damn, that's not bad then. So I would be watchful for Elon trying to pump some free trade Mexico opportunity. I think that could come, and I think it would be a boon for Tesla, and they would be one of the first sort of partners of this new free trade agenda, mostly because I almost guarantee it that in the future we will be back to free trade somehow, and I actually think that Musk's involvement with the Trump administration could make him a unique negotiating partner in discussions with countries like Mexico specifically over Canada. Now, whether we get these retaliatory tariffs, like, Carney is supposed to speak with Trump, but it hasn't happened yet, and blah, 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 whatever. It remains to be seen. Obviously, there's a lot of uncertainty in markets right now. The question is, how long is this tariff uncertainty going to go on? And how much longer-term damage or scarring is it going to cause? That's what we've got to pay attention to. So we'll see. But right now, I would say the tariffs are more bearish for the entire autos market. And it's also this idea about removing the EV tax credit in favor in the future of some sort of US-made tax credit does water down the edge that EVs had, right? If every car gets it, you do have this sort of downside. And you also have to keep in mind it's going to take a couple years to get a factory up in Mexico. So who knows, maybe it ends up being an Optimus factory or whatever in 2028. Giga Mexico. Mark your calendar, okay? By 2028, Tesla has some kind of robotics or auto manufacturing facility in Mexico under some new free trade. Mark your calendar for it. And then send me an email in the future if I got it right. And if I got it wrong, don't send me an email. But, just kidding. You can email me too. But I see that happening. The problem is we don't know if it will. It's an uncertainty. And for now, I would say the risk for margins at Tesla is unfortunately to the downside until some of these tariff issues get resolved, because those batteries are going to get slapped in the face. And the 4680s are just not economically viable compared to, well, outside, I mean, they work in the Cybertruck as a structural battery, which is fine. But I don't think they are economically viable outside of the Cybertruck in competition with the very inexpensive CATL batteries, the lithium ion phosphate batteries. So we'll see. But it's something to pay attention to. Yeah, some coalition. Yeah, exactly. Exactly. Okay, great. Okay, good. So that is my tariff chat. Now, let's see. I wanted to hit on Robinhood, too. I think that's a good one. Robinhood. Robinhood. Let's see here. Okay. And was there anything else I wanted to hit, too? So talk to Nvidia, tariffs. Oh, yeah, the Ukraine update. Quick heads up, Ukraine, Russia, Zelensky is freaking out because Donald Trump apparently keeps changing the deal regarding the minerals deal. So that he's complaining and expressing frustration about constant changes. And so that's got a little bit of a snag in negotiations here. And apparently Putin is threatening to now raise the number of service members in the Arctic, which is fascinating because Donald Trump wants to buy Greenland because of national security concerns, because of the polar channels up in the Arctic. And now Russia's like, yeah, we're going to put some more troops up there now if that's what you're going to be talking about. So I don't know. There's some signs that Putin doesn't want this to end anytime soon. And if anything, could be somewhat increasing some of the aggressions. So we'll see. Okay, that's a little bit on Ukraine. Now we got to hit... Oh, this is a good one, too, on tariffs. If you didn't see this yet, this was interesting. This is a shocker. OAG data collectors on air travel from Canada to the United States in March compared to last March doesn't show much of a hit yet, but watch what happens in summer travel. March year over year, down somewhere around 2 to 3.5% for Canadians traveling to the United States via airfare. Now, oftentimes air travel is booked months in advance, so this March over March comparison, not that bad. But what do we have for the summer season? Look at this. The summer season shows for April, May, June, July, August, September, an over 70 to as high as 75% drop in summer season bookings for Canadian travel to the United States. This is leading airlines to freak out about the start of tariff season and what it potentially means for the trade war in the long term. Cool. That's an interesting one. And then, so let's see here. Let's see here. Okay. Yeah. Okay. Okay, Hood. All right. So let's pull this up. I'm gonna look at the Robin the Hood. Oh, boy. Oh, they're 10Ks out. Let's go. All right, Vlad. Talk dirty to me. All right. Vladimir. I wonder if he gets mad if anybody calls him Vladimir. Some people don't like their full name relative to their nickname. I don't know. You never know. All right, come on. Where's their balance sheet? We're going to make it so hard to find. It should just be at the front. Never is. Bro! Give me the freaking balance sheet! Got it. All right, perfect. All right, cool. All right. Well, good old Robinhood is back at it again. Yesterday, with an over 1 hour long announcement, announced not only banking coming to you via delivering cash to you, but also some interesting advisory concepts. And I want to talk about Robinhood stock as an investment. So let's start there, and then I'll get into the announcements, because you may have already heard some of the announcements. Otherwise, we'll cover it in just a moment. The first thing that I like saying about Robinhood, when I look at the data for Robinhood, is I like seeing the unrestricted, unsegregated cashola. The cashola in the bank. Now, this company, in my opinion, has always been cash rich. We saw it when it was $7. They've been a cash rich company. I think they're pretty dang good at handling their finances. They also just don't have long-term debt. I mean, nominal over here. Other non-current liabilities are sitting at, 91 million bucks, but they've got 10 billion in current liabilities, but most of those being essentially segregated assets. So assets that you owe your customers because they deposited them with you for cash deposits or yield or whatever. The broker-dealer world makes it a little harder to analyze how much cash a business has, like securities lending or these fractional share repurchase obligations. They're the harder balance sheet. Now this on this left side here is 2023, and I want you to see the difference because the cash over this last year, their cash has only decreased by about 500 millis, and their current liabilities have moved up, and that's because their user growth is exploding, and that's before we really get into some of the serious juice of the business. So we've got a business that's got a good chunk of dough in cash. Let's take a look at their cash flow before we get to their net income so we can see if that size is increasing or decreasing. In 2023, their cash flow increased by about 1.1 billies, but over here, we actually decreased by about 157 mil in 2024. And when we look at free cash flow, it's roughly about 170 mil. So consider this. You have a company with about $4 billion of cash divided by about 170. It gives you about 23 years of cash burn in a free cash flow point of view. So point is, really cash-rich company. And what that's enabling them to do, along with a stock that's moved up, is it's allowing them to invest a lot, in my opinion at least, in new products, features, and R&D. And this is what I think is really interesting, because if you actually go to their financial statement, even though they're coming out with all of these new features, which again, we're just gonna hit in just a moment, their technology and development costs have actually declined substantially from 2022. Off the top of my head, we're probably down about 8% from 2022, and we're only up maybe 1.5% from 2023 in tech expenses. Vlad has gone in here with a chisel and has carved this business to the nuts and bolts of efficiency. He doged Robinhood before Doge was a thing. They went from operation expenses of $249 million down to 112. This guy's a top G, and then he's thrown all of it into marketing, basically. Look at that. They almost 3x their marketing while cutting their operations expenses in more than half. It's pretty dang impressive. And if you look at G&A, their administrative side, you've also seen a collapse in the G&A expenses by a little bit more than half. That's pretty impressive. And that's one of the reasons they actually have earnings now. Now, what makes Robinhood so interesting? Well, it's like, to me, extremely profitable, first of all, on options and crypto. Okay, let's be real. Options and crypto, that's where these folks make money. Now, I'm not exposed to the stock, so it doesn't matter to me if it goes up or down. But I want to talk about Robinhood as sort of like the future of banking, because that's really the direction that they're going in. First of all, they have the cash to play this game. They've got about 12% of their companies in cash. It's about a $40 billion company. It used to be worth a lot less, during some of the pain of 2022. And I think there's a chance that can happen again. In fact, if there is a larger stock market correction beyond kind of what we've already seen in the NASDAQ, which is really nothing, right? We've had a little haircut over here. But if we get back into something like a 2022 season where you have, a year of downtrending NASDAQ stocks or 13 months, Robinhood will probably perform very poorly, mostly because they make such a bulk amount of their money on options and crypto, which both of those being significant risk assets and being tied to trade volumes will probably suffer in a recessionary environment. But I think that could be one of the most beautiful buying opportunities, along with Restoration Hardware, which is trading for like a half peg and is making incredible investments. They will get destroyed in a recession, stock-wise, but they are building a company of the future and I actually think a lot of this it's so expensive stuff is gonna go away for Restoration Hardware, because I think they're going to end up turning into like the Chip and Joanna gains of the Gen Z and millennial populations who move again once real estate gets moving again, probably, in a couple years after we get through whatever this recession drama is or not. But Robinhood could suffer just like RH during that time. And I think it becomes a buying opportunity in part because what they're doing is they're trying to do what every single bank should be doing, but they're not actually restricted to the level that larger banks are. See, under the Dodd-Frank regulations, companies that are part of it, especially your big four, JP Morgan, Bank of America, Citi, and Wells Fargo, they're really restricted with a lot that they can do in terms of lending, a lot that they can do in terms of new options or features for their customers, because banking regulation is really, really tight. In fact, most people say you don't want to invest in a bank or own a bank. You want to use a bank. So you usually want to be separate from a bank. But fintech and lending has big dollar hollers. This is where you're seeing Rocket Mortgage tie up with a Redfin, and I think it's a brilliant deal, by the way. Very, very smart for Rocket Mortgage. They're getting Redfin at a steal, I think somewhere around 1.4 billion bucks or whatever. I mean, it's a fart for the valuation of what Rocket Mortgage is, which is also about a $40 billion company. Another one that after the poopy doopy we go through should do very, very well on the upswing. But when you look at Robinhood and some of their latest announcements, this idea of delivering app to you, it's not about, oh, okay, you don't want to go to the ATM because you don't want to leave your house or your office or whatever to go pick up $500 in cash so you could go to the strip club later, or you could go on a vacation and you Uber basically euros to yourself or whatever. All that, like the service of this I think is brilliant. But what it's doing is it's showing that Robinhood is really like the financial app of the future. It's the app where you go to incorporate your net worth, your checking account, your savings account, your children's retirement funds. It's really marketing in a way that M1 Finance wishes they could market. In fact, a lot of what Robinhood's announcement was about, in my opinion, borrows from what M1 Finance has done for quite a while. This idea about, they literally took the pies idea to allow you or enable you to invest in these sort of like pies, right? And they'll sort of like auto rebalance these or whatever for you. This is exactly what M1 Finance has done for years. But Robinhood has the marketing. It's absolutely brilliant because I don't think that they're necessarily going to earn a ridiculous amount rapidly on fees, but I think they're going to get a lot of users using it, and as they get the AUM, the fees will be remarkable for the company. Because think about it this way. Robinhood's announcement is that if you use their financial advisory services, which it's not like you're going to have a personal financial advisor. You can't pay for that with $250 a year of maximum fees. But what you've really done is you 5x the revenue for a gold customer. And remember, Robinhood makes a lot of money off options and crypto, but it's not recurring revenue. It doesn't get you through a downside. What gets you through a downside is that gold subscription. People forgetting that they're paying $5 a month for Robinhood Gold to get their investing analytics or margin or yield on cash deposits or whatever. That's worth $60 a month. Well, $250 a month, or a year rather. That's worth $60 a year. $5 a month. $60 a year. $250 on top of that for sort of unlocking their advisory opportunities, talking like auto-filling your tax return. Brilliant. Have a question, ask a CPA. It's sort of like Intuit support. They'll have to massively expand their customer support base, but they're the company that pioneered the 24-hour, I think it was the 24/7 call center. Have questions about how to trade options? Call them. Okay, do the same thing with taxes. Do the same thing with financial advisors. Just anybody who's an advisor can look at your stuff and give you an opinion. It's what SoFi has, by the way, done for years. SoFi has actually provided free financial advisors for years because the idea isn't to sell you financial advice. The idea is to get you to pay a little bit more per month, 25 bips of your AUM up to $250 max per year, roughly 5xing what Robinhood's revenue is off of you without you trading. See, they got the traders by the balls, as any trading platform does. Options are very profitable. Crypto spreads, very profitable. A lot of money to be made there. But there's a limit to how much people are going to trade in a downturn. There's a limit to how much people are going to trade in an upside as well, because not everybody trades. But getting that long-term investor who's just going to park their money in your app and sit there and not realize that that $300 or whatever a month you're paying, compounded by many millions of users, is brilliant. Like this is so smart for not only the downturn times but also the long term. JP Morgan wishes they could do an app like Robinhood. Can JP Morgan buy Robinhood? JP Morgan, not that Robinhood would ever be open to it. JP Morgan is a $700 billion company. JP Morgan should buy Robinhood. Honestly, but I don't know. Once that happens, then all of a sudden you have a bank holding company owning a fintech, and you ruin all of the fintech aspects of it anyway. So they can't. The regulators have JP Morgan by the balls, where Robinhood can do whatever they want in the fintech space, but they're not screwed by a bank holding company. Kind of brilliant. So Robinhood is really uniquely positioned for this next downturn. Enormous amount of cash, rigorous discipline and cost cutting, and these announcements over, investing into various different exchange traded funds that they auto manage for you, talking to a tax advisor through the app included in this, net worth reports, spending controls for your children, starting the process of creating a trust right from the app. Brilliant. Send cash internationally through the app to friends on the app. It's sort of their version of Zelle. Brilliant. It's like the blue text message for fintech. Book travel, drivers, tickets through the app, whatever. That's a little bell and whistle. Nobody really cares about that. But what Robinhood's missing right now, and if I had a message to Robinhood, it would be you really need to get into business accounts. And then after that, you could, expand your lending opportunities, like credit lines for businesses. But I think there are a lot of small businesses out there right now, especially in this moment in time where people are suffering, that would love a new banking relationship like what Robinhood offers. And so for me, it's not a buy at this price, but boy, if they get cheap, again, which I think they will if we go through this economic poopy-doopy that I think we're going through or about to go through, I'm pretty excited about the company. The company itself, fantastic POV. Let's do a valuation on them quickly. The valuation of the hoodles. So right now we're sitting at 39.2 billies. We don't have a cash concern. We love their pricing power. I'm always a big fan of the foundations, right? No bankruptcy risk, pricing power, then a low valuation. And I like to be in a position of low enthusiasm. We're in a low enthusiasm time. I think we'll be in a much more low enthusiasm time when folks start realizing, crap, we could be in for an economic slowdown that's worse than expected. I hope not, but it could be. But as far as the valuation right now, if I look at their $1.47 of projected income divided by the current price, 44.27 divided by $1.47. Come on, Kevin. 44.27 divided by $1.47 puts me at 30 times. And the growth that the company is expecting, Wall Street is not seeing the growth. I think Wall Street is way, way discounting this growth for this company. They only see 26.4% growth over the next 4 years. That works out to 6.6% on a growth rate. That's crazy. That's so low for this company. I don't buy it, but that's what is currently estimated. Puts the company at 1.73 divided by 6. It's trading for a 4.2 peg. So right now on a peg ratio basis is ridiculously overvalued, partly because Wall Street's estimates are very low for it. But the point is, when with those low estimates, Robinhood stock aligns with like a 2.4 peg. So if it's trading for like $22 or less, whew, this is the bank of the future, especially with the regulatory tailwinds that the company has. Thanks in part to Trump's deregulatory push. Like Trump's deregulatory push really won't become evident probably for the next 4 years. Like the seeds for the next deregulation bubble are being planted now. I agree with Musk. We're overregulated now, but the seeds of the next 2008 are being planted now with the deregulation that's coming. I don't know what the consequences of that could be. In 10 years, we could talk about a recession again. We still have to get through this one first. Maybe. I'm like 70% on it. But boy, this, I have to say, Team Vlad, Team Robinhood, fantastic job. And out of the other finance apps that are out there, there's some that I like. Like Public's gotten really good. They're giving Robinhood somewhat of a run for their money. SoFi's incredible. Still torn on where I stand on like the Moo-Moos or whatever. M1 Finance, I wish they could market themselves better. There's so much opportunity there, but because that's a great application as well, and they're doing great things, but nobody knows. I don't see any. Where's their marketing? So please call me so I can help you, or like I'll privately give you my opinions. You don't even have to pay me, but I feel bad M1's getting left behind. But anyway, very cool. So some of my thoughts on Robinhood. Okay, doke. He is the impaler. Well, they got through that pretty well. So yeah. All right, cool. What else do we got? Deregulate into the next GFC 2.0? Yeah, it's going to happen at some point. I mean, that might be 15, 20 years away. I don't know. It could be 10 years away. It just depends. Like I said, he's still got to focus on this wave.